Most people think you need a fortune to start investing in the US. They wait until they have $10,000, $20,000, or even $50,000 before they feel ready. But let me tell you something. That waiting is the biggest mistake you will ever make. The truth is, in the world of finance, time is more powerful than money. The best time to start was yesterday, and the second best time is right now with your first $1,000. Think about it. While you're waiting to save up, inflation is quietly eating away at your cash, making it worth less every single day. You aren't just waiting, you are literally losing the power of compound interest, the eighth wonder of the world. Today, I'm going to show you a simple 3-step strategy to invest your first grand. This isn't about getting rich overnight or chasing the latest crypto scams or gambling on meme stocks. We are talking about proven, long-term wealth building that balances total safety with massive growth potential. By the end of this video, you'll know exactly where to put that $1,000 so it can start working for you while you sleep. No more confusion, no more fear. Let's build your future, $1 at a time. The foundation, getting your house in order. Now, before we jump into the stock market and start buying assets, we have to talk about the foundation. You wouldn't build a skyscraper on sand, right? Investing is the same. There are 2 financial fires you need to put out before you can grow that $1,000. First, the debt trap. Take a look at your credit cards. If you're carrying a balance with an interest rate of 18, 20, or 25%, stop right there. No investment in the world, not even the best stocks, can consistently beat a 25% interest rate. If you invest that $1,000 while owing money on a credit card, you are actually losing money. Paying off high-interest debt is a guaranteed return on your investment. That is your first big win. Second, the emergency safety net. Life happens. Cars break down, medical bills pop up, or unexpected expenses arrive. If you invest all your cash and an emergency hits, you'll be forced to sell your investments at the wrong time, possibly at a loss. This is why I recommend taking at least $500 of that first $1,000 and putting it into a high-yield savings account, HYSA. Like we discussed in my previous video, an HYSA keeps your money liquid and safe, but it also pays you 4 to 5% interest while it sits there. Once your high-interest debt is gone and you have a small cushion of cash, you are no longer just gambling with money you might need next month. You are now a strategic investor ready for the next step. The best first investment, buying the entire market. Now that your foundation is solid, let's get that remaining money into the market. But here is the golden rule for your first $1,000. Do not try to find the next hidden gem stock. Most beginners lose their first grand because they put it all into one hot company they heard about on the news. Instead, you want to buy the entire market. This is where index funds and ETFs come in, specifically those that track the S&P 500. Think of the S&P 500 as a basket of the 500 largest and most successful companies in the United States. When you buy an ETF like VOO, Vanguard S&P 500, or SPY, SPDRS and P500, your $1,000 is automatically spread across all 500 companies. If one company has a bad year, it doesn't matter because the other 499 are there to hold you up. Historically, the S&P 500 has returned an average of about 10% per year over the last several decades. Let's do the math. If you just put in that first $1,000 and added just $100 a month into an S&P 500 index fund in 30 years, you could be sitting on nearly $200,000. That is the power of passive investing. You aren't working for your money anymore. The 500 biggest corporations in the world are working for you. The best part? It takes zero effort. You don't need to read balance sheets or watch the news every day. You just buy, hold, and let the American economy do the heavy lifting for your wealth. The secret weapon: tax advantages and apps. Now, you've picked your investment, but where you hold that investment can be the difference between retiring with a good amount of money or retiring as a millionaire. In the US, the government wants to take a piece of your profit. This is called capital gains tax. But there is a secret weapon called the Roth IRA. When you invest your $1,000 inside a Roth IRA, your money grows 100% tax-free. That means when you turn 60 and withdraw your hundreds of thousands of dollars, the IRS cannot touch a single penny of your profit. It is all yours. So, how do you actually do this? You need a brokerage account. Forget the flashy apps that encourage gambling. Stick to the big three: Vanguard, Fidelity, or Charles Schwab. These platforms are solid, have almost zero fees, and are built for long-term investors. Simply open a Roth IRA account on one of these platforms, transfer your $1,000, and use that money to buy an S&P 500 ETF like VOO. It's that simple. You've just set up a tax-free wealth machine. Conclusion: your future starts today. Look, the hardest part of investing isn't the math or the apps, it's just starting. Most people will watch this video and do nothing. They'll wait for another perfect time, but not you. You now have the roadmap. Fix your foundation, debt, and emergency fund. Buy the entire market with the S&P 500. Use a Roth IRA to keep your profits tax-free. Remember, the secret to wealth isn't timing the market. It's time in the market. Start today with your first $1,000, and 20 years from now, your older self will thank you. If you found this guide helpful, hit that like button. It really helps a new channel like SmartBucks USA grow. Comment below with the words, "I am starting today to commit to your financial freedom." And if you want to know how to build your first $10,000 emergency fund fast, make sure you're subscribed, because that video is coming up next. Thanks for watching, and let's keep building those bucks.